You may have been told that an issue age or community-rated Medicare Supplement or Medigap plan would protect you from large rate increases as you get older. That sounds good in theory, but in the real world, we're still seeing major increases across all three Medicare Supplement rating methods. With an Attained-Age Policy, the increase may be called an age adjustment or a birthday increase. With an issue age policy or community-rated policy, rate increases may be blamed on claims experiences or rising healthcare costs, but everyone is still receiving a rate increase. The label changes, but for the policyholder opening the bill, the results can look remarkably similar: a much higher premium. Hi, my name's Hannah Skinner, and I'm a licensed insurance agent at the Senior Savings Network. Today, we're explaining the three Medicare Supplement rating methods: Attained Age, Issue Age, and Community Rated. Is one rating method superior over the others? Will one keep your rates lower over time? And more importantly, we're going to explain why these rating methods do not always work as neatly in the real world as they do when they're marketed to you by insurance companies. By the end of this video, you'll understand why a health insurance policy that supposedly does not increase because of age can still have major rate increases, and why the rating method alone should never determine which Medicare Supplement company you choose. A rating method explains how the insurance company uses your age when calculating your premium. It does not tell you how often your premium will increase. It does not tell you how large these increases will be, and it certainly does not guarantee that your premium will remain affordable. This is where a lot of people become confused. In a vacuum, these three Medigap plan rating methods appear very different. Attained age policies can increase every year as you get older. Issue age policies are based on the age you were when the policy was issued. So if you bought at 65, your rate will be lower in theory than if you bought the same policy from the same company at 75. Community rated policies generally change the same base rate to everyone within the rating group, regardless of age. But that only explains one part of how rates are calculated. Insurance companies can also request increases based on rising healthcare costs, inflation, claims experience, the number of policyholders remaining in the particular block of business, and other factors permitted by the state. That means all three rating methods can and do experience significant rate increases. They may simply be explained differently on your renewal notice. Let's begin with Attained Age rating. With an Attained Age policy, your premium is based on your current age. Every year as you get older, your premium can increase because you have moved into another age bracket. The company can also apply a broader increase to the entire group of policyholders. Sometimes a company's start age increases after 68 to keep the new retirees who are 65 through 67 still in the plan, but then they do higher increases from 68 onward. For example, a person may receive a 5% increase because of their age and an additional 15% company-wide rate increase because of claims or medical inflation. Those two adjustments could produce a total increase of 20%. This is the most straightforward rating method because the policy clearly allows age to reflect the premium. Claims experience generally tells us that the public has more health problems as we age. Attained age policies also tend to have attractive starting prices, especially for someone at 65. The problem is that some people choose the lowest starting premium without considering how age adjustments and company-wide increases can stack on top of each other. However, attained age is not automatically worse than any other method. An attained age company with a stable group of policyholders and a better rate history could perform better than an issue age or community-rated company experiencing large group-wide increases. That's why we have to look beyond the label. With an issue age policy, your premium is based on your age when you purchase the policy. If you buy the policy at 65, you remain in the company's age 65 issue category. Your premium should not increase simply because you turned 66, 70, or 75. The rating method is the only one allowed for insurance companies selling Medicare Supplement plans in Florida. In theory, this sounds much more stable than attained age pricing. But it's important to understand exactly what the policy does and does not protect you from. Issue age protects you from an increase that is specifically attributed to getting older. It does not protect you from rate increases applied to everyone in your policy group based on medical inflation or lots of claims being filed. If the insurance company says claims were higher than expected, healthcare costs increased, or the entire block of policies needs a rate adjustment, your premium will still go up. Your renewal notice might not say your rate increased because you turned 70. Instead, it may say the increase is due to the experience of your policy form or rating class. The wording is different, but your monthly bill is still higher. Community-rated policies generally charge the same base premium to everyone within the same rating group, regardless of age. A 65-year-old and a 75-year-old may therefore have the same base rate. There can still be differences based on location, tobacco use, household discounts, payment method, or other factors permitted in that state. Once again, this sounds very stable in theory. You're not moving into a more expensive age bracket each year. However, the rate for the entire community can increase, and we generally see much higher rates for people at 65 because they're paying the same rates as people who are 95 on the same plan. If the company's claims rise or the insured group becomes more expensive to cover, the insurer may request an increase for everyone in that rating group. So instead of receiving an individual age increase, every policyholder could receive community-wide or block-wide adjustments. You avoided an age-based increase, but you did not necessarily avoid a major monthly premium increase. If the group becomes unprofitable, the insurance company can close the block to new business and still orphan older members in the old block with high premiums due to the higher claims experience. The company then opens a new block for young, healthy people who can be medically underwritten with lower premiums. So sometimes community rated doesn't work over the course of 30 to 40 years like some clients think it will. Here's the type of situation that we see in the real world. Imagine 3 70-year-old policyholders. Each person has a Plan G. Each policy has a different rating method. The first person has an Attained-Age Policy that costs $150 per month. The company applies a 3% age adjustment and a 12% general rate adjustment. That person's new premium rises to approximately $173 per month. The second person has an issue age policy that also costs around $150 a month. The company cannot rise the premium simply because the person turned 70. However, it applies a 15% increase to the entire policy group because of claims experience and rising medical cost. The premium also increases to approximately $173 per month. The third person has a community-rated policy at $150 per month as well. The company does not apply an age increase, but it raises the community rate by 15%. That person also ends up paying approximately $173 per month. These are simplified numbers, but this demonstrates what we're seeing in the market. On paper, these 3 policies were priced differently. One increase was partly related to attained age. One was called a policy group increase. The other was a community-wide adjustment. But all 3 policyholders experienced the same increase. The insurance company may use a different description, but your bank account doesn't care what the increase is called. Medicare Supplement companies are paying claims in an environment where healthcare costs are rising. Hospital care, outpatient services, financial services, testing, and medical treatments have all become more expensive. Insurers also look at the claims experienced within a specific group of policyholders. If a group is aging, submitting more claims, and losing healthier members who switch to other companies, the remaining group can be more expensive to insure. This is sometimes referred to as a shrinking or aging block of business. As healthier policyholders leave, the people who remain may be those who cannot easily change plans because they would have to pass medical underwriting. This creates additional pressure, pushing premiums up and up and up. In these cases, the insurance companies often play a shell game. The insurance companies close the shrinking sick older block, Block A, and open a new block, Block B, for healthier people with lower rates and big introductory discounts for enrolling. In most states, Medicare Supplement benefits are standardized. A Plan G must provide the same standardized medical benefits regardless of the company that sells it. You therefore can receive a large premium increase without receiving any additional benefits. Some bad agents may make rating methods sound like a guarantee. They may tell you that an issue age policy will never increase because you get older, or that a community rated policy is automatically safer because everyone pays the same rate. Technically, those descriptions may explain how the age is treated, but they can create the false impression that the policy is protected from the substantial increases. It is not. We've seen major rate increases with attained age, issue age, and community rated companies. That doesn't mean that the rating method is meaningless. It's still something that you should understand, but it's only one piece of a bigger decision. You also need to consider the company's rate history, the size of its policyholder group, whether the company is still actively enrolling new members, available household discounts, the premium you're starting with, the company's financial stability, and whether you could pass medical underwriting if the rate becomes unaffordable later. An issue age policy with a poor rate increase history is not automatically better than an attained age policy with a more stable history. A community rated policy with an aging or shrinking group is not automatically protected from large increases. And the least expensive company today may not remain the least expensive company forever. Unfortunately, no agent can guarantee what an insurance company will charge 5 or 10 years from now. But that doesn't mean that you're powerless. If you live in a state like Florida that only allows one rating methodology, you can advocate to your Department of Insurance to allow multiple Medicare Supplement rating methodologies to help keep the free market working and to drive premiums lower. No matter where you live, you can work with an independent broker who can compare multiple companies instead of representing only one carrier. You can review your rate regularly with that broker and determine whether another company offers a more competitive option. However, depending on your state and enrollment rights, changing Medicare Supplement companies may require medical underwriting. That means you cannot wait until a serious health condition develops to review your options. And never cancel your current Medicare Supplement policy until your new Medicare Supplement has been approved and you've confirmed its effective date. The plan benefits are not different based on the rating methodology the company uses to file premiums. You cannot be canceled from any plan regardless of its rating methodology for getting sick or getting older. You are guaranteed to keep the same coverage year after year as long as you pay the monthly premium. And your state Department of Insurance has to approve any rate increases your Medicare Supplement company files. So if a rate increase isn't justified by higher claims, cost will not be justified by your state government. Medicare Supplement ratings work neatly in theory. Attained age increases with age. Issue age is based on age when you purchase the policy. Community rated generally does not use age to set the base premium. But in the real world, all three types can receive major increases to your monthly premiums. One company may call it an age adjustment, another may call it a claims experience increase, and another may call it a community or policy block adjustment. Different label, same result. You're paying more. So don't choose a Medicare Supplement based only on its rating method or only on the lowest premium available today. Look at the whole picture, including the company, its rate history, the group of policyholders, and your ability to change coverage in the future. At the Senior Savings Network, we work with more than 30 insurance carriers. That allows us to compare current premiums, rating methods, household discounts, underwriting requirements, and company rate history. If your Medicare Supplement premium recently increased, give us a call at the number below. We can help you determine whether there's a more competitive option available and whether you can qualify to make a change. And if this video helped you understand what's really happening behind Medicare Supplement increases, give it a thumbs up, subscribe to our channel, and share it with someone who has watched their premiums increase year after year. Thanks for watching, and we'll see you in the next video.